Hello everybody. Major news outlets keep shouting about institutions buying Bitcoin, yet the price stays stuck. So what's really happening? How did Michael Saylor secretly buy 425 million in Bitcoin without moving the market? So today we are going to reveal this hidden playbook of how big institutions buy Bitcoin. So we have a lot to cover here today. Let's get right into it. So when it comes to trading and investing, I would like to point out two major important players, if we can split them in this way. We first have the retail traders and investors who are, normal people like you and I who go ahead, open an account on whatever crypto exchange are there, like Coinbase, Binance, whatever. And then we start trading Bitcoin, right? We buy, we sell, so on and so forth. So these are the retail investors. We're going to talk about them later on because they are important in this topic. And then we have the market makers. Who are the market makers? So as you can see right here, market makers are financial institutions or big firms that actively buy and sell securities, providing liquidity to the market. So here an example, we have Strategy or MicroStrategy, Fidelity, and MetaPlanet. Those are the big institutions who have been buying and selling Bitcoin, especially recently in 2024 and 2025. They usually facilitate trading by quoting both bid, or the buy, and ask, or sell prices, ensuring investors can readily buy or sell assets. This presence of market makers contributes to efficient and liquid markets. We can also point out here other crypto exchanges like Coinbase and Binance, for example. They can be considered market makers as well. But we are going to stick to the definition of big institutions who are actively buying Bitcoin for the sake of simplicity. And how those big institutions buy Bitcoin or Ethereum. They do it by using OTC, or what we called over-the-counter. So when we are talking about OTC buying, is the process of buying or selling financial instruments directly between two parties. So remember that we talked about here the big institutions and the market makers like the crypto exchanges. Those will be the main parties of the OTC. They do not use a formal exchange like retail investors do. Like if you have a look at MicroStrategy or MetaPlanet, they do not log into the trading platform of crypto exchanges and then they start to buy and sell Bitcoin. This is not how they work. So this is also what we call a decentralized approach. This offers flexibility, but they have the biggest advantage of reduced transparency. It also marked by less regulations compared to the order book or the exchange from the retail investors. And how does these over-the-counter purchases actually work? So whenever we have market makers or big institutions who wants to buy Bitcoin, they use the big advantage of the volume-weighted average price. So this is a institutional technical analysis that is used to calculate the average price of a security, in this case Bitcoin. It usually takes into consideration the volume and the price, because both of these factors influence deeply the trading performance of retail investors. So as opposed to the New York Stock Exchanges, as opposed to the New York Stock Exchange or NASDAQ, which are financial exchanges with centralized financial exchanges, you're going to find that the price of the assets that is displayed on those exchanges is only one. If you have a look on Apple or Amazon, there is only one price for everyone who wants to trade it, because that's what we call the centralized exchange, as opposed to over-the-counter or decentralized exchanges. But big institutions, if they want to buy Bitcoin, they have to consider the fact that it is a decentralized exchange. It means that in the entire planet, for all the exchanges, you're not going to find only one price for Bitcoin. So since this is decentralized, you're going to see that different exchanges provide different prices. So especially from the perspective of the retail investor, each one of those exchanges, they apply markups to the prices, which we're going to call spreads. So that's why one price in one exchange is going to be different from one another. And you, as a retail investor, you're not going to buy the best Bitcoin price compared to big institutions, okay? All right. So whenever those big companies who wants to buy Bitcoin, they take into account, for example, the CME group, which is the Chicago Mercantile Exchange, or is the world's leading and most diverse derivative marketplace. So they take into account what price is being displayed on the CME. They also take into consideration what price is being displayed in different exchanges. And that's going to help those institutions to buy such Bitcoins on the best volume, on the best VWAP. Because it makes sense when you stop to think about it. You as a retail investor, as much money as you have, you're not going to be able to compete with big institutions when it comes to volume. So that's the biggest advantage that those institutions have compared to you. And that's why they trade over the counter with the crypto exchanges. Okay? And when we get into more detail about how exactly that purchasing works, they use the smart order routing. So what is smart order routing? Smart order routing is an automated process in trading in which possible venues are identified to execute a buy or sell order based on real-time market data. It analyzes various factors like price, liquidity, market depth to find the optimal execution of an order. So, as the name implies, it is going to route the orders throughout the most advantaged places for execution. The biggest priority here are efficiency and cost optimization. And since we are talking about the over-the-counter processing, buying processing, it is not going through the exchanges directly. The smart order routing from those big institutions through the exchanges are going first to partners, miners, and institutional sellers. So you can see right here that partners could be considered other institutions, other big institutions who already hold Bitcoin and they purchase from one another. The next option will be the miners, who, as you know, they mine Bitcoin and they are already generating Bitcoin. Maybe they're storing those Bitcoins on cold wallets. They are not reaching the exchanges. So whenever you have to purchase from them, you're not going to affect the prices. And lastly, you have other institutional sellers. Perhaps those big market makers or those big institutions are going to buy from institution A, a little bit from institution B, a little bit from the institution C. So when you take all that into account, those big companies are able to accumulate a huge amount of Bitcoin and the price does not change. Why? Well, exactly because they're not buying like you. So this is the order book. This is where most traders and most investors, either spot, margin, or future traders, trade their Bitcoin. So it is important to understand how order books actually work, because this is the heart of price behavior, ladies and gentlemen. If you understand how order book operates, everything is going to be more clear on why the price is going to one direction or another. But here it is. This is pretty much a list of pending buy and sell orders for a cryptocurrency on an exchange. It matches buy and sell orders to determine market prices. So you're going to see here that we have listed pricers who are willing to pay, or the bids, while sell orders are listed at prices traders are willing to sell at, or ask prices. So as you can see, they aggregate liquidity depending on the order levels, also including supply and demand, and they optimize order matching and price discovery. So let's say that you want to buy Bitcoin, okay? The way that the order book is going to fulfill your order is from the best price to the worst price. Let's say that you want to buy 0.0007 Bitcoin. This is the best price you're going to get right here. So this level of the order book will be filled out. And let's say that now I want to buy 0.0880739 Bitcoin. This level of the book is going to be filled out. Of course, we're talking about an exchange, a marketplace where we have thousands of buyers and sellers. So this is going to be filled out like in milliseconds, right? That's why you see the price going up and down, which is pretty much buyers and sellers making, as the name implies, deals based on the order book. So this is pretty much the explanation of how the order book works for you and I. But here's the thing. Let's stop for a second and remember that. Let's say that eventually you as a retail trader and the institutions, you are going to meet each other again. When big institutions, they have no more OTC and no more decentralized resources to buy their Bitcoin, they are going to go to the exchanges. But here's the thing, when you stop to think about that, think about Michael Saylor for a second, right? And then imagine that, okay, no more sellers, so I can buy Bitcoin. I'm gonna have to rely on the order book on the exchanges. And let's say he wants to buy 5 Bitcoins, just 5. With only one order, he's going to wipe out this level, this level, this level, this one, and partially this one. Do you see what happened here? The price quickly went from 10,694 and went to 10,699. This is for 5 Bitcoin, which for some can be a lot. So now you imagine how would be the order book behavior if you're buying 10 Bitcoin. This is going to be wiped out quickly. And how about 20 Bitcoin, 50, 100? Now do you get what's the relationship between the order book and the price? This is exactly how it works, guys. Okay? Alright. So here's what happens. After big institutions, they started to realize that over-the-counter prices, they start to get not so good. We're going to have to rely on the exchanges. Even though big institutions, they are everything, but they're not dumb. They will first, the first thing that they're going to do is not to wipe the price right away. They're going to do something that we call accumulation. You're going to identify supply and demand zones, and big institutions, they are going to wait for the prices to go to those levels and start buying again because they want to get the best prices. So as you can see right here in this example, this timeline right here in the chart, this was clearly an institution buying. So whenever any hedge fund or index fund or ETF, their algorithms identify that the price is in a big advantage or the alpha or whatever, they buy. And now you see why the candle is so high. The candle increases because the order book was filled out. But they still have a lot of margin to buy more Bitcoin. But they're not going to buy all at once. They buy a little bit and they wait the price to go back down. Perhaps another institution just sold a lot of Bitcoin and then the price goes back down. That's why you see this is maybe can be referred as a war between big institutions. They're trading, literally. They're trading each other's markets. And something that happens when we have accumulation on the exchange's order book, and the big institutions know that. You as a retail trader, you have no volume, remember? That's why they go to over-the-counter in the first place and they fight with the VWAP. You have no volume and you have no patience. You see, at the time of this video, we have been on accumulation stage for over a month. Traders who are extremely greedy, they start to place short-term trades because they want money quickly, and they do something that institutions love. They use leverage. You want to see where most traders are placing their leverage trades or their stop losses or their liquidations? Is the liquidation heat map. Like I told you, we have been consolidating over a month. And looks what happens as time goes by. I mean, around here, there were barely any liquidations available. Now, as time goes on, traders start to get impatient and greedy. And they try to predict the markets, you know, all the kind of stuff that we're not going to discuss here in this video, but technical analysis, so on and so forth. And then everyone starts to think, okay, price is going to go up. So they start to place their stop losses here. Like, oh, there is a breakout right here. Stop loss, liquidations. But big institutions, remember, they dominate the order book. You do not. You can try as much as you want to buy as much Bitcoin as you want. Price will not move. But keep in mind that big banks, big companies, they have much more volume, much more margin than you. And when they see that you placed your stop loss right here, they are going to sell a bunch in order to get more liquidity from you. I mean, I'm not talking about you as a person specifically, But the masses of traders, they behave like this, and big institutions know that. So as time goes by, you see that more liquidation starts to form on the edges of the zone. That's what we call supply and demand zone, which for the institutions are going to be premium and discount prices, better for them. Now, what comes after that? Right? We are accumulating, institutions are trading. Eventually, again, everything comes down to the order book. You have those prices. Eventually, the book is going to be filled out. And then, first thing that you're going to notice is that ETF inflows or big institutions inflows are still coming in, while at the same time, Bitcoin reserves on the exchanges are decreasing. Now, this is a simple supply and demand market law. What happens if everyone starts to buy bananas? The price of banana is going to go up. What do you see in this chart is the availability of Bitcoin on the exchanges is going down. And when you see that the availability of Bitcoin going down, you're going to start to notice that the prices are not going to be the best. Eventually, quote unquote, worst prices are going to come in. And some big institutions are going to make a purchase or sell. And yes, one time or another, after this long time of accumulation, no more good prices. Boom. And the cycle repeats. Eventually, after that happens, hedge funds, ETFs, and index funds, they start to fight each other again. And then we're going to have a good trading zone, premium discount prices. Bitcoin is going to be fed back into the exchanges. Retail traders are going to participate in the trading game again. But remember, in this situation that you see right here, retail traders is an extremely small piece of the puzzle. This is exactly why you see that big institutions and the market makers, those are the ones who rule the price. I mean, it is actually why they are called market makers. They are the ones, in my perspective, who are making the market to happen, right? So here's, again, if I could summarize with a one metaphor, going back to the bananas, right? Imagine that Michael Saylor is the owner of a big supermarket, let's say like Walmart. If Walmart wants to buy bananas, they're not going to the same market that you go as an end user, end consumer. No, they're going directly into the ones producing bananas. That way, the price of banana is not hugely impacted, because otherwise the banana would be wiped out from the supermarkets, and that's how they can buy big volumes or of whatever asset. It can be Bitcoin, bananas, cars, whatever. This is how big institution operates, and the difference between big institutions and the retail traders. So pretty much this is the stage one of market makers purchasing over the counter. Then the stage two would be the accumulation on exchanges. And then finally, when there is no more financial assets available on the exchange, then trade wars from the financial trading system perspective and price discovery, new premium discount zones, so on and so forth. So this is pretty much it what I would like to tell you guys. Share your thoughts in the comments. Thanks for watching. See you in the next video.